I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning, everyone. I'm T3 Live Editor-in-Chief John Darcy.
And I'm Brittany Umar, and together we bring you Morning Call. So world markets are mainly up a little bit. Our futures are pointing to a higher open this morning on news that the dovish Janet Yellen is expected to be announced as chairman of the Federal Reserve later today. So, John, is this something that could help our markets get back on more solid footing?
Well, congrats to Janet Yellen. I think after Larry Summers withdrew his name from consideration for Fed chairman, I think it was somewhat of a formality that Janet Yellen was going to get the nod. And maybe the president was perhaps holding this announcement in his back pocket for a time when the market needed a little bit of shot of adrenaline. And so overnight, after yesterday's carnage in tech and some other areas in the market, we get that announcement that the dovish Yellen is going to be the next nominee for Fed chairman. She's expected, I think, to get enough support to get the nomination. I don't think it's going to be a terribly contentious situation in Congress. But I don't think it's going to be too much of a lasting shot in the arm for the market. I think it's going to be a short-term boost because I think she is dovish, but it's hard to really get more dovish than the current Fed chairman, Ben Bernanke. I think it'll bring a little bit of continuity to have someone that's currently a big voice in the Fed currently to be the one taking over the reins to lead the FOMC. But I still think we might not taper QE this year, but I still think we're on track. I think we've come to the largest QE we're going to have in this cycle, and I think heading into the beginning of 2014, everybody's going to have their eye on potential QE tapering.
So for the meantime, then, heading into the open today, what are the key levels that we should be watching?
Taking a look at the S&P, yesterday, obviously, we got that well-publicized break of the uptrend that's been in place since the November reversal. Take a look on the weekly chart to get a better view of it. We've had a very defined uptrend that's held multiple times in 2013. But the key now, we've dipped below it. We dipped below it back here on the week of June 29th. But we were able to climb back above it on a weekly chart, close back above the 21-week moving average. We tested it again, went back to highs. Now we're testing the 21-week moving average again, and we are below this trend line. But the key will be whether we close below it on a weekly basis. Futures are up this morning, so it'll be interesting to see whether we can build on this bounce a little bit and try to climb back towards this trend. That would keep a thread of bullish composure intact, but yesterday did feel like a little bit of a complexion change, and it doesn't sound like in Washington they're any closer to coming to a compromise. Both sides sort of digging in their heels, unwilling to negotiate, and come together and come to some sort of agreement that would raise the debt ceiling. And that deadline's October 17th, so I think you could see anxiety, despite the fact that the market's oversold, I think you could see anxiety continue to grow into that deadline.
Well, let's make sense of the action then that we saw yesterday and how it translates into today. We did see a lot of major damage in the tech sector, especially in social media stocks. So first, John, do you think this is potentially hedge funds making room for the Twitter IPO? Yeah,
I think that's sort of the buzz right now, is that everybody's sort of going goo goo gaga for Twitter. They don't really care where it's priced. They've seen, I think because of some of the runs we've seen in these other social media type stocks, I think everyone's unconcerned about Twitter's lack of revenue and their lack of monetization of their platform right now. I think everybody understands the potential for Twitter and wants to buy into that growth story because of some of the moves we've seen in these types of stocks. But yeah, I think that could definitely be happening, and based on the action yesterday, I think it's definitely a very valid observation.
Right, let's take a look at some of them. We did have LinkedIn that was pushed down another 6%. This is after a 2-day sell-off. What do you do with it here? Yeah,
LinkedIn had an absolute monster move from its IPO. I remember going back to the monthly chart, I remember when it IPO'd, really strong IPO, went into the triple-digit area. Everybody was saying this stock will never grow into this valuation. It's maybe topped out on its IPO day or the day after its IPO day. But then after probing the lows from that IPO day, huge rally, gone up about 4 times, 400%. And it's in the context of the chart, it's not terribly surprising to see a big down move like this. but the way it happened yesterday is a little bit concerning. And I think if you're a short-term bull on LinkedIn, I think a potent down move like yesterday can lead to more downside unless we're able to quickly reclaim most of this bar. So I'd definitely take caution if you're a LinkedIn bull.
I would imagine that we should take caution with Yelp as well, which we know has had a big run recently, but it got hit among the hardest. It had a 7.6% retracement yesterday and fell below the 8 and 21 day.
Yeah, Yelp is one that benefits from a lot of companies perhaps wanting to own media properties, and there's been some takeover speculation with the company, and then they are growing their revenues a decent amount. It doesn't justify the current valuation, but all that sort of combined to help Yelp have a big run. Take a look at the chart. You can see obviously huge harsh down move yesterday, closed well below the 21-day moving average, in jeopardy of breaking below this upper level base. If it does start to enter this gap, it gets filled around 59, so that's an area to keep an eye on as potential support, as well as the beginning of this gap at 61. That would be about another 5% down move, but if it can't, just the same way with LinkedIn, if it can't reclaim a lot of this potent down move and it's sort of choppy and rests after yesterday's drop, I think it definitely could see those areas, and that'll be the first support level to watch, is that $59 to $61 area.
Pandora as well fell almost 8% to break below its 8 and 21 day. What's the next support level you'd watch here?
Yeah, Pandora is one that I think is extremely ripe for competition. You have all these other internet radio companies out there. You have Spotify, you have Songza, and then you have Apple iTunes Radio came out. And this, if you follow me on Twitter, if you look at the chart, when it was trading up here around 27.50 on the first go round, and the Apple iOS 7 update came out, I talked about how the new Apple iTunes Radio is getting a lot of positive reviews, and I thought it could weigh heavily on Pandora. And we got an 11% drop that next day in Pandora. It was impressive to see the stock rally back to highs. It came out with some data about song or music usage on the website and things like that. But then yesterday it got cracked big time, closed below the 21-day. Another one that has an important gap from mid-September that I think obviously the first support level will be the opening of that gap after you get past this short-term upper-level pivot here, and then a potential gap fill that would line up also with the prior breakout level. So of all these stocks, Pandora is one that I am very bullish on, or very bearish on, excuse me, one that I think could definitely see more downside.
All right, what about Facebook? It did slip. It actually tested its 21-day for the first time since earnings. Would you say this is actually a buying opportunity?
Of all these social media type stocks that maybe are making room for Twitter, I think Facebook is the most attractive in my opinion, both from a technical and a fundamental perspective. I think the growth story is just starting to pick up in Facebook. They've started to figure out mobile advertising. They announced they're putting ads in Instagram. They're starting to monetize Instagram for the first time. Talking about putting video ads in Facebook news feeds that Morgan Stanley said it could generate as much as $20 billion by 2020, I think. So a lot of really good things fundamentally going on with Facebook, and also it's the first time that Facebook has touched its 21-day moving average since that big earnings gap and go to the upside. So as you can see on the chart, just below the 21-day yesterday. Be important to see whether it can reclaim it today. But if it doesn't, it has this prior breakout level around 46. That'll be an important area to watch for support. But like all these others, you want to see it quickly reclaim yesterday's potent down move and see if it shows any relative strength to its peers in the industry. So I want to keep an eye on one that I'm most optimistic could bounce back.
Well, and meanwhile, we saw flights to safety in several areas. We're going to go in the trenches with some of those right after this quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF. I'm Mark Sperling, Director of Trading.
Amid yesterday's action, we did see flights to safety in sectors like the utilities. We saw the XLU gain 0.7%. Now, this is a sector that's been lagging the market for the past 2 quarters. Is this a signal that it's time for this one to play catch up?
Yeah, I think the flight to safety yesterday was just another sign that some of this fear and panic is real in the market, and you're seeing real money rotate out of riskier type stocks like tech, like biotech stocks, into safer assets like utilities, like consumer staples. And I'll just run through those quickly and not force Brittany to introduce each one individually. Talk about the XLU. XLU yesterday was up, 1.5% for most of the day. It did close well off its highs and back below the 8 and 21-day moving average, so could be a sign that this is a transitory type bounce. But in general, this flight to safety could be something that a short-term trend that we see into that October 17th debt ceiling deadline as people try to hedge themselves a little bit. I think most people expect Congress to get something done, but with some of the scenes that we've seen recently, anything's on the table, I would say. There's more voices coming out and saying that they believe there's a higher possibility of default than most people realize. So this flight to safety over the next week or so, I think, could happen. But over a longer term basis, I think it's definitely more of a short-term trend in a rising interest rate environment, which is what we are getting into and what we'll get into when the Fed starts tapering QE. I think things like the utilities are headed lower. Consumer staples, another one. Yesterday, they finished around the flat line, but just another example of a sector that shrugged off the weakness yesterday and how weakness was very isolated in tech, in biotech stocks. You saw the NASDAQ drop 2% while the S&P only dropped just over 1%, so good indication of that. Gold, poor gold, tried to bounce. With all the market turmoil, a lot of people were looking at gold for a potential bounce, but it closed negative in the afternoon. It was weak. So, just something to keep an eye on there. I think it's a very bearish sign for gold. Gold is very hard to day trade. If you're a very short-term trader, I would steer clear of gold, focus on stocks, maybe indices if you feel you have some sort of edge there. But I generally think a stock-specific approach is best. And then bonds yesterday as well. Bonds were strong. Finished barely positive, but held up in sort of that turmoil that we saw in the market, and still above the 8-day moving average, which is the key technical indicator there, sort of in a descending channel. I think we could potentially break higher in the bond market given the environment we're in right now.
All right, let's do some quick hits here. Let's talk Solar City, which did find some buyers early on in the session yesterday and pulled back with the overall market, but closed well off its lows, so some relative strength there.
Yeah, Solar City is one that we've been highlighting and off the charts a lot over the past few weeks. We highlighted it this past Wednesday prior to this bar. So after this bar right here, we highlighted it. Great 2-day move and great 3rd-day extension. If you follow Scott's methodology of buy on day 1, sit in it on day 2, potentially add on day 2, and then trim and trail on day 3, you might have trimmed and trailed into the top of this move here. But in general, you talk about a doji candlestick here is a candlestick of indecision, could lead to a pause in the momentum for Solar City. But whenever you see a candle like this, you have to analyze it in the context of the broader market. And yesterday, the broader market was obviously very weak. The tech sector was very weak. So Solar City, it's impressive to see it close positive yesterday, despite the fact that it had a wide travel range. It isn't the action you'd like to see. It wanted to go yesterday, but was just weighed down by those broader market forces. So I think when the market does firm up, today futures are up a little bit, I think Solar City could be one of the first ones to go higher. So definitely keep it on your radar.
All right. And how about Apple? We have Apple up this morning on news of a product event on October 22nd that is rumored to potentially be the new iPad. What are the key levels to watch in Apple today?
Yeah, Apple is one that's sort of holding on to its last thread of bullish composure. It's sort of in a wedge pattern. We can go ahead and take a look at the chart. Yesterday it had a harsh down move, but just barely closed below its 21-day moving average. So it's, like I said, holding on to its last few morsels of bullish composure. And then with the gap up this morning, it's still holding into this wedge. So look to the top end of the wedge and the bottom end of the wedge as your points of reference. If we break below, you could potentially look to short it, I think. If we break higher, you could potentially look to buy it. It's as simple as that. That's why we love wedge patterns. It gives you really defined levels. This is one that I'm pretty bullish on Apple on an intermediate to longer term. I think some of the demise of Apple has been a little bit overstated. I think their new products have been pretty well received, and this iPad could give them a nice revenue push into the holiday season.
How about Whole Foods? It had a breakout failure, but what do you think about the composure of the stock still?
Just like I talked about Solar City, you got to analyze charts in the context of the action in the broader markets. So yesterday, if you take a look at the chart, yes, you did have a very loud breakout failure in Whole Foods Market. You have to respect breakout failures, but when you consider that the stock wanted to break out in the morning, sort of like Solar City, wanted to go higher, but then it just succumbed to the broader market forces and the baby got thrown out with the bathwater, as they like to say. But it did still close around the flat line, still above its 8-day moving average, still in this upper level base firmly. So when the market does firm up, I think Whole Foods Market could definitely be one of the first ones to break out.
And Goldman Sachs hanging by a thread at the current trendline support at 153. Seems like this is a pretty crucial level that it's at. Yeah,
I mean, Goldman Sachs, it's tough to short it right here considering how far it's come in. The banks have been a big drag on the market, as have been the home builders and things like that. But you zoom out to the weekly chart to get a better view of it. Goldman Sachs sort of put in a triple top. I mean, I guess you could sort of say a head and shoulders as it briefly made a new high in this breakout failure, but call it a triple top, whatever you want to call it. It's coming into major support from this rising trend line of this pattern, so very crucial level. In the short term, like I said, I think it's tough to short here because it's very oversold, but in general, not acting well. It got added to the Dow. That hasn't really had the boost for Goldman Sachs like most people maybe hoped or wanted it to. So this is one, if it does get a little bit of rest, sideways action, maybe a small bounce, I think this is one you could potentially look to have on your short radar.
All right, so in closing, what are the key things to focus on as you head into the trading session today?
Yeah, I mean, I think the best approach continues to be a cautious one. I think in a headline, random type tape, you can get moves that don't really follow the mechanics of technical analysis and things like that. So I think you keep your exposure low. I think you take a very stock-specific approach, focus on those stocks that wanted to break out yesterday, for example, but weren't able to because of broad market forces. And I think you keep things tight. I think you wait till a little bit more clarity comes on the debt ceiling situation, which is about a week away. So I think you keep things close to the vest. I think playing defense is the best offense right now, and a lot of great investors would tell you that that's the first step to being successful in the market is focusing on defense. So right now, keep yourself out of harm's way and focus on the few names that we talked about that showed some relative strength yesterday.
And that's your morning call for this Wednesday. Happy trading. Have a great day.